And thank you everybody for joining us today. We got a cornucopia of information on these slides. So um, Tanner's going to start out and talk about some grain market fundamentals and what's going on there. And then after that, Jacqui will hit the biofuels situation with a healthy dose of policy updates. Throughout the course of action, if there is a question, comment, feel free to punch it in as we go. We'll try to get to questions during the event, and then afterwards we will leave at least 10 or 12 minutes at the end for Q&A as well. So with that, I'll turn it over to Tanner.
Thanks, Rob. And well, good morning or good afternoon to all of you, wherever you're located. We've got a lot to cover this morning. And top of mind for everybody, I'm sure, is August 1st. What happens August 1st? Well, that's when the tariffs are supposedly back on. And that's kind of been the theme here, really over the last several months. What is the tariff situation? This is obviously hugely impactful for the grain trade and to our customers in the grain trade, and trying to forecast where this is all going when tariffs are always in flux. They're on, they're off. We had a 90-day pause. The White House sent out a letter some weeks ago reminding all of these countries that we trade with that if they don't have a trade deal with the United States by August 1st, we're going to impose tariffs. And President Trump meant business when he said that. Or so he had indicated. We've had a few trade deals, and that has been a positive here. Here recently, we had a trade deal with Japan. That was more about how we might be able to impact or increase our rice exports in terms of agricultural commodities. Here recently, a deal with Europe, and now sitting on the table apparently is a deal with China as we sit in Stockholm, as the U.S. and China talk in Stockholm about a potential deal heading into August 1st. So a lot of uncertainty about where this is all going, and obviously, if we do issue tariffs on August 1st, we could be back in a situation where we have retaliatory tariffs that could negatively impact our exports. With all of these macro uncertainties unfolding on trade, on biofuel policy, which we'll have Jacqui talk in depth here in a moment, it's not been a positive story on grain prices. As you can see here, in the basket or the portfolio of commodities broken out by industries, you have grain, the grain index there as measured by the Goldman Sachs Commodity Index as the blue line. That's been underperforming compared to a number of other commodities. The only other commodity sector that has been struggling more than grains has been the energy sector for a whole host of reasons. There's slowing global economy, a lot of that due to trade uncertainty impacting commerce. But grains have been impacted not only by trade uncertainty, but also the fact that we've got some major crops coming this fall. And we're going to talk about that here in a moment. This is on top of record crops in South America, record crops out of other countries like India. We had big crops last year with China. And so all of these factors fundamentally are weighing on the grain complex. Additionally, here, we got to talk about what is also happening in the macro world as it is with the U.S. dollar. As you can see here, the green line is the U.S. dollar index. We peaked in January, and we've been declining ever since. And what happened in January? We had the changing to a new administration and all the trade uncertainty that went with it. And as you can see here, there's been a fleeing from the dollar over to perceived safer assets like gold. This is typically a positive for agricultural exports. A cheaper dollar makes our exports more affordable abroad. So let's take a look at what what has transpired over the so far. This is the latest data from USDA FAS, which is derived from census data, year to date, compared to where we were last year at this same time. Change year over year with each of these commodities. We have all the major grains. We have ethanol. We have soybean meal. We have tree nuts and dry beans. All of these commodities that we export. What's the story here? Well, it's a bit of a mixed bag, if you will. We have some commodities that are doing extraordinarily well. Really, corn here is the standout commodity, and we really have Mexico to thank for that. It seems every other day we have a flash sale from Mexico buying more corn from the United States. A lot of that has to do with the fact that Mexico has been struggling with a drought, and so they've been importing more corn from the United States. We benefit from that because of our strategic location, being right across the border. Rail rates have been favorable, and so we've been benefited from that trade. However, go down the list here. It's not as bright of a story. There's some other commodities that have been doing well. Soybean meal, because we've been producing so much of it, because of our expanded crush capacity here in the United States to meet our renewable fuel objectives. Ethanol exports up. Jacqui's going to talk about that here in a moment. That's mostly due to exports to Canada and their biofuel initiatives. Everything else, though, has been a bit of a negative story. Now, how is that possible? When we have a tailwind of a weakening dollar, we should be seeing exports increase. Well, it comes back to the trade uncertainty that we talked about earlier. So many of these commodities are being negatively affected by trade uncertainty. Really, the ones being impacted the most here, cotton and grain sorghum, by far have been impacted most by the loss of Chinese demand. We need that Chinese trade deal sooner rather than later because so many of these markets are impacted by the fact that China simply is not buying from the United States currently. We're going to go a little bit more in depth on some of these markets, specifically corn, wheat, and soybeans and grain sorghum and what that means going forward. June 1. On June 1st, we had corn stocks down a little bit from last year. That's mostly owed to the fact that we had a little bit of a smaller crop. But we've also had, like I said, very strong exports, very strong ethanol demand. This has been a huge positive for corn. However, we got to talk about what's going to be happening this fall. We've had rising usage and tighter supply because of that, and that has lifted corn prices higher earlier in the year. However, you can see that chart on the left. We have turned and we are heading south. A lot of farmers are looking in the cash market at sub $4. That is not a very profitable price for most producers. They're going to have to grow their way out of these low prices. They're going to have to bushel their way out, if you will, with record yields if they're going to have a profitable year this year. What that means then is that we have a major crop coming this fall. Right now, as it looks, with crop conditions around the United States, or for most of the United States, being phenomenally positive on USDA's good to excellent ratings, we're looking at a record yield. Now, right now, USDA is penciling in a record trend line yield of 181 bushels per acre. Okay, that is not a yield estimate that is derived from surveys. That is statistically based. Okay, in the August crop report, USDA will have their first estimate on based on surveys of farmers and fields. And right now, based on crop conditions as they are, the whispered number out there in the trade is that we're going to have a crop yield somewhere in the realm of 183 to 185 or more bushels per acre. And this is on expanded acreage. Remember, we expanded planted acreage this year. So as you can see here, USDA is currently penciling in a little over 15.5 billion bushels. But if we had conceivably a national yield, folks, of over 186 bushels per acre. That is a 3% increase over USDA's trendline estimate. That would be like adding another Wisconsin to the U.S. Corn Belt, and nearly over 500 million bushels added to the crop. If indeed we end up with a 3% increase over trend line, that's like adding another Wisconsin. Folks, this is a lot of corn we're going to be dealing with. We're already talking about the implications of what this means for this fall. We're going to be very tight on storage. Now, although June stocks were down year over year, these numbers here erase that reduction. We're going to have a lot of corn piled on the ground. What does this mean on the carry? As you can clearly see here, the spread between September corn futures and December corn future contracts is clearly rising. The market is pricing in this record crop and is incentivizing already storage of the new crop. We're going to have a very tight storage situation, and this is going to be a battle for bunker space, if you will, around the United States. We're hoping that we have a dry fall as a result with all the corn that's going to be stored on the ground. Soybean stocks up a little bit over last year as of June 1st. That was mostly owed to the fact that we had a bigger soybean crop, but also our demand situation has not been nearly as positive on the export front like we wish. But on the positive story here on the demand side has been crush. The record U.S. soybean crush has replaced a lot of our lost export demand, and that's been positive on soybean prices. You can see here that's been elevating soybean prices ever so gradually as we expand crush capacity here in the United States to meet our renewable fuel obligations. Jacqui will have more on that here in a moment. Production is expected to be down slightly this fall, but there again, it depends upon what we have for a yield. Right now, USDA is forecasting 51 and a half thereabouts on national yield. We're probably going to be above that, and so we may not see the reduction in total bushels available this fall, even though we had reduced acreage. Remember, we still got to get through August before we start taking those estimates seriously on yield for soybeans. But right now, as it looks, soybean crop conditions are improving across the Midwest. So taking the data as it is right now, we're going to have to anticipate we will see above trend line yields at harvest. The market is clearly signaling that we're going to be storing more soybeans for a couple of reasons. Number one, like I just talked about, we are anticipating above trend line yields on soybeans, and that means we're going to have a healthy harvest as it is right now. But look at what's going on in the carry between SEP and NOVE contracts. And you can see what's happened here over the last several weeks, and then really over the last couple of weeks. The carry has really increased a lot there, a big rally in the spreads. There's another story here we got to talk about. We mentioned this earlier. Folks, we are getting a little concerned here about the lack of Chinese demand. China buys about 20% of all of our soybeans that we grow. This is a very important export market for us. As you all know, we can't crush our way out of these soybeans. We can't use all the soybeans that we produce right here in the United States. We have to export. If you're going to export, you've got to export to China. As it is right now, we still do not have a trade deal with China, and this is getting concerning because we have not one sale on the books to China, folks. Not one bushel of soybeans of new crop is on the books for China right now. This is getting a little late in the year, and therefore it's getting a little concerning. Now, let's be cautious here about how dire the message is. China will have to come back to the United States. There's no doubt about that. They've had record shipments this summer out of Brazil. They've had record lineup of ships out of Brazil. So they have been trying to buy as much as they can out of Brazil. Those Brazilian stocks, therefore, will be depleted. At some point, China will be forced to come to the United States, trade deal or no trade deal. We would like these sales to be on the books ahead of harvest because our shipping pace in the Q4, that October, November, December period, sets the trading pace for the rest of the year ahead. We have to perform in that Ocnov-Dees window. Otherwise, we will be having to carry more soybeans into the new year, past January 1st. That's not an ideal situation for exporters, folks. That will be an ideal situation for U.S. crushers. They will have more availability of soybeans in country to use domestically. But in terms of the U.S. balance sheet, it will be supply heavy if we start missing out on some of these Chinese sales. Moving on to wheat, we just have the latest numbers from USDA. They released their first estimate of the all U.S. wheat crop this July in the July WASDE report, the July crop report that included their estimate on the spring wheat crop in addition to the winter wheat crop. And USDA is anticipating a slight drop from last year, mostly on the big drop in crop acreage as farmers transition acres out of wheat and over to the row crops, mainly corn and soybeans. This has been a long-term trend, and unfortunately, that trend has continued into this year because wheat just simply has not been able to compete on profitability, mostly because of the increased competitiveness out of the Black Sea region. U.S. wheat stocks on June 1st have been or were quite ample. This is an important factor we have to consider because of the quality of this year's crop, especially the winter wheat crop, soft wheat and hard wheat in Kansas, or the hard wheat and the hard red winter wheat crop in Kansas and the central and southern plains had some quality issues with wheat streak mosaic lowering test weights. You also had some rains during harvest, and so the test weights have been dropping in areas that were affected by ongoing rains. And so what that means then is a lot of elevators and a lot of flour millers are going to have to blend new crop with old crop stocks. This crop also had a lot higher yield. Our bias here is that USDA is going to have to increase their yield estimate on the winter wheat crop because yields were so high in some areas. What that typically means is that when yields go up, protein levels go down, and that's going to create more demand for high protein spring wheat. And you can see that happening in the spreads here. Look at Minneapolis hard red spring prices. That's the high protein crop, or the aristocrat of wheat, as they say, the high protein crop. That's maintaining its value versus the winter wheat crops traded in Chicago and Kansas City. Again, twofold there. You have a smaller spring wheat crop because of the loss of acreage, but also because of this increase in demand for protein because of the lower protein values in the winter wheat crops, especially hard red winter. Here's the breakout by classes for those of you who are carrying wheat. USDA is factoring in a reduction across all the classes except for white wheat. That's pretty much the crop up in the Pacific Northwest, grown in Oregon, Washington, and Idaho region. Everywhere else, acreage is down, and so that means production is down. Again, we would argue, though, that production might actually be a little bit higher, especially for hard red winter and soft red winter, given the high yields that were reported. Before we transition to the last couple of slides on grain sorghum, the market is clearly signaling that it wants the elevators and merchandisers out there to put that wheat into storage. We've got some very handsome carries here across all the classes for Chicago, Kansas City, and Minneapolis wheat. And there brings in the argument about what we're going to do with storage this fall. If you are in an area that has wheat and corn and soybeans and grain sorghum, this is going to be a very interesting dynamic. It will be a fight for storage. Do you carry the wheat, or do you move the wheat out and out of the grain elevator, and do you make space for the corn or the wheat, or excuse me, or the soybeans or the grain sorghum? Well, this is a good problem to have. I will say that this is a good problem to have, especially for those elevators in the wheat belt that struggled with crop production over the last several years. Now you have the choice of several crops here to choose from on what you're going to do with your storage. Rounding it out in the last couple of slides here before we hand it over to Jacqui, USDA is forecasting or is estimating a bigger carryover on sorghum stocks. Sad story here because of the loss in Chinese demand. Remember that China takes about 90% of our grain sorghum exports. We're having a tough time trying to scare up that demand here in the United States when you have so much corn coming this fall. What livestock feeder wants to feed grain sorghum when you can feed corn? Corn is king when it comes to feeding. So as a result, a lot of the ethanol producers out there have taken advantage of these ample sorghum stocks, and we've seen record usage for ethanol production from sorghum. But folks, it's just not enough. We cannot replace China when it comes to exports, and that's reflected here in the grain markets. You can see here prices in Western Kansas. Special thanks to the Garden City Co-op elevator. This is their cash data. You can see the spread there between corn and old crop corn and old crop sorghum prices. Sorghum prices are widening versus corn. Again, the market is trying to stimulate some demand there, and without China, it's going to have to really come from ethanol demand. USDA is forecasting a bigger sorghum crop coming this fall again. A bit of a surprise there on acreage that the U.S. farmers didn't cut out more sorghum acreage, but it fits in a lot of farmers' rotations. They like to grow it, and so here we are. We're going to have more sorghum this fall. So it's going to be an interesting story on how we're going to be managing these bushels going forward. Last final thoughts here. There's some positives here. We've got some record production coming this fall for our fall crop. We're going to need a weaker dollar to help stimulate our exports. We've got some favorable biofuel policy that's going to increase local demand, but it's not going to replace that lost export demand. We really have to have those export deals inked sooner rather than later because we are operating in an environment of global abundance, and our competitors are getting more competitive, folks, not just on bushel capacity but on policy. You have Argentina is cutting their export taxes. You have Russia slashing their interest rates, and the ruble is getting cheaper. Our competitors are getting more competitive as we sit on our hands with trade deals, folks. I cannot stress enough, we need a trade deal with China as sooner rather than later before we head into the cheap export season of October, November, December.
Hey, Tanner.
With that, I hand it over to my friend and colleague, Jacqui Fatka, our lead economist for biofuels and farm supply. Jacqui, the floor is yours.
Hey, Tanner, we had a question come in um, regarding storage uh, capacity in the U.S. What's the trends been in the past few years, on farm, off farm? What do you see the next couple years forward?
Well, if you look at the numbers USDA comes out with every December, there's been an increase of both commercial and on-farm storage. There's been in the reduction in the number of elevator locations because what co-ops are doing is they're replacing out-of-date elevators with bigger, more efficient facilities. So although the number of locations is shrinking, the total bushel capacity has been increasing. And then at the same time, farmers are increasing on-farm storage because they have more control over their marketing program. They have more options in terms of where they can haul their crops, whether it's to a grain elevator, or excuse me, a ethanol plant or a soy crush plant or a flour mill. Farmers have more options there. and with their marketing when they have their own storage. So it's increasing really on both fronts. But I'd say, there's the trend here of on-farm storage is probably the more surprising one. In some states, farmers have really gotten after it. They know that, that's an investment that pays. And in some instances, they have that storage paid for in the first year based on higher margins that they capture from better marketing. So I would anticipate we're going to continue to see farmers moving in this direction of having more of their own on-farm storage.
Yeah, and just as an aside, those tariffs on steel are not going to facilitate that process.
Right. Hopefully, we that's a whole other discussion, Rob. Thanks for going down that rabbit hole. We don't have the time to go down that one.
All right.
But you are correct. That is in for the time being. That is an issue.
All right. Let's move on to Jacqui now. Jacqui, take it away.
All right. Well, thanks, Rob, and thanks, Tanner, for a great start. When we talk about the biofuels policy, just a few months ago, we didn't have all of what I'm kind of calling the three-legged stool of our U.S. biofuel policy. And so I'm going to talk a little bit about each one of these. Some of these we know a lot about, some of this we know a little bit about, and we do still have some unknowns within the space. So the renewable fuel standard is the major biofuels program here to encourage domestic blending, and we do have some new insight out from that. SREs is the small refinery exemption, so we're going to talk about that, and then also the shift to the 45Z clean fuel production tax credit, which was previously part of the Inflation Reduction Act, but also some updates were made in the One Big Beautiful Bill. So we're going to go through a little bit of the demand and outlook in each one of those that is established through those legs of the biofuels policy. First off, though, I'm going to talk a little bit about ethanol margins. As you look at the last couple of years, we've had some highs and lows. Some of this is impacted by the net cost of corn. We started off 2025 with actually some negative margins in the ethanol industry. So we're starting to see those returns over operating cost improve. Obviously not at the levels that we saw, those highs that we're seeing in 2023, but back to profitable levels, which is obviously good for the industry. A big part of that is because of ethanol exports. We're coming off of a record 2024. So much of this trade uncertainty, though, does impact the ethanol ability to export. And I'll talk about this a little bit in a few slides ahead. But ethanol is being touted as one of the opportunities for increasing exports to a lot of these countries that we've had early agreements with. As we look at just the start of the year, we were up 10% from the January to May from last year. So we started off with really strong numbers in 2024. We've already started off in 2025 building on that. As Tanner mentioned, Canada remains a very important market for us. Nearly 2/3 of our ethanol is sent there. As we look at the most recent month data, May, exports overall expanded 7% for the month, setting a record for the month. But again, this is just so important to have those ethanol exports. As you look back at the RFS, the ethanol mandate has been pretty steady, and really we're over the 10% blend wall, but those higher ethanol blends are really not able to move the needle in ethanol demand very fast. But when we start to pick up these ethanol exports into these markets around the world, that's where we really start to see some of that positive margin improvement as well. So as I mentioned, as you look back at last year's where we were sending our ethanol. I misspoke. I said 2/3 of our ethanol was sent to Canada. Is actually a little over 1/3. So my apologies there. But still a major market. We started off kind of this trade uncertainty with some discussion around Canada, and we're also going to be updating USMCA here in the next. I would say we're going to see that here at the end of the year, but definitely as we head into 2026, that has to be reevaluated. Canada remains a very important market for U.S. U.S. ethanol, and very, very important to maintain, if not build upon that market as well. You look at some of these other countries, and this is the reciprocal tariffs that were announced in April, and now we are in that stage of which ones are being reevaluated and whether President Trump is going to give them a higher amount, lower amount. A couple of them on this list we've now got some agreements with. We have something with the UK. Their agreement did tout $700 million in ethanol sales. As you look at last year, though, they purchased $535 million. So maybe not a huge surge in what they did. A lot of these actually allow for just a change in the tariff rate quota, which means that the amount that would be able to come in with a 0% tariff would be set at a slightly higher amount. It doesn't necessarily guarantee that they're going to buy that. It just sets up a situation where the tariffs could be lower and we could increase sales there. We just had a deal over the weekend with the EU. We're not necessarily sure how exactly the ethanol will fit into that picture. We're still finding out some more details about that EU deal specifically. Another important one on this list is India, and we have a lot of ethanol that does go there right now, but they're actually not using any of that in their transportation fuel supply. Everything is for industrial use. So there is some opportunities if we are able to reach a deal with India, that if there is some changes in allowing U.S. ethanol to be used in their fuel supply for road use, that we could really ratchet up that level even higher. So again, just kind of building on where ethanol can maybe create some more easy wins. And a lot of countries have their own domestic goals of what they want to blend biofuels. And so being able to utilize U.S. ethanol or even renewable diesel or biodiesel can help these countries meet these mandates. And so, several of these, this chart just kind of outlines here on the right, you see their blend goals established by that country, but then you actually see where they are at today. And so, obviously China is very much under their goal, only at 2.3% of a 10% goal. India, the same, only about half of what their goal is. So again, creating some opportunities to really build on expanding trade into these countries, helping them meet their own domestic goals. And as it looks, when you're comparing importing corn versus importing ethanol from the U.S., sometimes we know that trade obviously protects domestic producers. And so trade can be tricky when it comes to agriculture, especially when you're talking about grains and commodities. But when you're looking at a biofuels, it's a little less sensitive. And so I think that's another reason why we're seeing ethanol be touted as this way to increase ag exports that does end up benefiting our domestic corn producers, but maybe not displacing India corn producers as an example. So shifting gears a little bit here as we looked at the renewable diesel and biodiesel, as you see here, we definitely fell off a cliff as we started the year, and our renewable diesel and biodiesel production was way down. A big component of that was the fact that we saw a shift from the dollar tax credit that was given for biodiesel and renewable diesel producers and shifting to the 45Z clean fuel production tax credit, which is based on a carbon intensity score. There is more variability in just establishing what that level would be. So we went from a dollar tax credit to this 45 tax credit, and the industry was also dealing with the unknowns of the renewable volume obligations for next year. And so we literally fell off a cliff. We are building back up, which is good news. A lot of those facilities either shut down or slowed down or idled basically just to keep people paid, but we're not producing very much. So we do expect to build as we head into the rest of the year. And some of that is based on what we just saw out here just a couple of weeks ago with the renewable volume obligation mandate. So the bio-based mass diesel was really the biggest winner in that new set rule. This looks at all the different categories of renewable fuel. So that top blue chunk is really your corn ethanol. That's your conventional renewable fuel, but that's basically the 10% blend that we would have to meet based on overall gasoline supply and the ethanol use in that. And again, ethanol is a preferred octane additive to your supply of gasoline. So we really don't have that blend well consideration anymore. We're, about 10.35%, maybe 10.4% of the total gasoline supply. So that's been a pretty steady and not a huge demand driver. But the big change here is what you looked at in that dark green, that biomass-based diesel category. The EPA, the last couple of years, has established what they called a set rule. So the last set rule was from 2023 through 2025, and it established what the industry could potentially blend and establish that mandate for that amount. Well, you looked at even 2024, 3.85 billion gallons was the last set rule. We actually produced about 5 billion gallons last year, and there was a lot of criticism within the biomass-based diesel industry that EPA, when they proposed that rule for 3 years in 2023, that they underestimated demand. And sure enough, that came true. So there was a lot of requests, a lot of industry that had asked for higher levels. And that's what we got with this set rule 2, the right side of the chart here, that shows that we do actually have the opportunity to blend a higher amount. And so a lot of good news for the industry in that sense of being able to push demand in a higher these higher renewable volume obligation amounts. So this increase from 2025 through 2026 is actually a 61% increase of the mandate, but we're actually, it's much less when you look at what we actually produced last year. And so that's important to realize too, is that we were already overproducing. We produced about 5 billion gallons last year. So even at this year's level, we were producing more than that mandate. And again, the mandate is supposed to help encourage, push additional capacity and help fuel growth. But when the mandate was set underneath lower than what the industry could produce, it doesn't create that same incentive to push demand. One of the really interesting tweaks that happened with this RVO proposal is that EPA is trying to reward those domestic feedstocks and disincentivize in some ways the use of imported feedstocks. So for every gallon of fuel produced, you get what's called a renewable identification number, a RIN. And so as you look here at the chart, from 2018 to 2021, we saw a pretty, steady use of imported feedstocks and imported biofuels. But then as we turn to 2022, and this is also when renewable diesel really started to pick up production of renewable diesel, which is a drop-in fuel, so that can be directly replaced with diesel. It doesn't have the same blending restrictions that biodiesel had. You started to see a real surge in our imported feedstocks and imported biofuels. So what EPA is trying to do is create a new incentive for those domestic feedstocks, but we don't know if we can meet that whole, as I mentioned that chart before, if we can meet all of that with our only domestic feedstocks. So you think about domestic feedstocks, soybean oil, we have a little bit of canola oil, but not very much here domestically. Corn oil would be a domestic feedstock which is a byproduct of the ethanol industry. But we do import a lot of tallow. We do import quite a bit of used cooking oil. So looking back and seeing how that imported feedstock, when you look at the overall pie, all of the feedstocks that go into the pie to make our biofuels, renewable diesel or biodiesel, all of them, we've seen a real shift most from the soybean oil to an increase of tallow, even though they use cooking oil. Now we've increased production, total production overall, and so total pounds is still a lot, but the share of the pie, we've seen soybean oil's share of the pie go down considerably here in the last couple of years. This EPA proposal, which I will mention again, is just a proposal. They'll finalize that rule. Comment period closes next week. They'll finalize that rule by October 31st to go into effect November 1st. The idea is that we could see quite a bit of a change in the overall soybean oil demand. So again, biodiesel and renewable diesel, we used to have this about 50%. We've now seen a shift to much more renewable diesel production, and biodiesel has stayed pretty steady. Biodiesel, you can only blend up to 20% in your diesel, whereas a renewable diesel can be a 1-for-1 change. So in some ways, you can actually use 80% renewable diesel and 20% biodiesel, but we do expect that renewable diesel is going to meet more of that biomass-based diesel demand that was set in the RVO. So going back to that pie and how it will change the pie. So we look at last year in the soybean oil used for biofuels, and then what could happen with the proposed change in the RIN values for domestic feedstocks. We could see a really big surge in soybean oil demand, as much as 3.8 billion pounds in 2026, and possibly another 1.9 billion pounds in 2027. EPA in their proposed rule, did look at a few different scenarios of whether we see the same levels that we had before. Do we see about 83% of feedstocks coming in domestically versus, the rest exports? Some of this is going to change, and some of those facilities, their access to being able to run different feedstocks is also changing, right? A refinery that's in California, it was advantageous for them in some ways to have a boat come in with used cooking oil, rather than maybe a rail car that would take 3 or 4 or 5 days with soybean oil to get to them. And so we're going to have to see how this all fits together in the final RVO, and then how this is really implemented. Some refineries are able to use different feedstocks the same, and so they can purely go on economics, and we're going to see how this all changes as we go forward. If it really does encourage more domestic use, what we're seeing in the soybean market is that's likely because of the fact that we are seeing an uptick in the soybean oil prices for that. But we also know that every bean you crush, you get oil and meal. So we also have to find some place for that meal to keep our soybean crusher margins positive. So another thing to think about each year that every year you can roll forward your balance, this RIN bank that's generated to the following year. But the fact that we've had this cliff that happened in 2025, we won't have as much of a bank built up this year as we look to next year. And so we're seeing a little bit of that happen right now with trying to get RIN market values, because you do get a price point is given to a RIN if people need to buy a RIN. We're seeing a little bit of market react to that right now, trying to get the production to come back online. So that other, one of those other legs of the three-legged stool is this treatment of the historical small refinery exemptions. And in EPA's proposed rule, they mentioned that they're going to be doing something about those. The timing is that it's likely to be ahead of the final RVO decision, so we could see that here in the next couple of months. They are looking at potentially 34 qualifying and operational small refineries. How or whether they reallocate those. So, this SREs are supposed to be given to those smaller refineries so that they wouldn't have to comply with meeting the mandate, that they could ask for a waiver and be exempted. The question is then, does it get reallocated to the larger facilities, or does it eliminate it, or does it just lower the overall mandate demand? And so that's what we're going to be watching and waiting for. That is one of the unknowns that we just don't know for sure. sure yet as we head into the rest of the year, and that will also build into the final demand that we would see in 2026 and 2027 based on how this EPA does deal with these SREs. So the other last leg of the stool is the 45Z. And as you recall, the Inflation Reduction Act did have 45Z, which was through the Biden administration in 2022. They passed this change in a tax credit that would benefit, give a greater tax incentive to those fuels that had a lower carbon intensity. Originally, that was a 2025 through 2027 tax credit, but there was a lot of calls for that to be a longer period. So the Congress did extend that through the end of 2029. It was one of the very few tax credits that is considered a clean fuel tax credit that was included in this all Republican only passed bill that came out of Congress this summer. A few tweaks that it did as well, it does limit the feedstocks to those produced in North America. So that only it does basically eliminate, for instance, Brazilian tallow from being able to qualify for that tax credit, but it allows canola from Canada to come in. Another really significant change it made to the indirect land use not being able to, it basically eliminated the penalty that comes with indirect land use. So it's going to improve your CI scores for your corn and soy products. Another important change that it created in the One Big Beautiful Bill was it allows that transferability of credits, which means that if you, sometimes you have to make money to take a tax credit, but if you can sell that, then you can capture that money. So this is really important for our farmer-owned ethanol plants. But I will say the biggest loser in the changes to the 45Z was actually the SAF industry. And that's because the original Inflation Reduction Act had a $1.75 tax credit for SAF, but only a $1 tax credit for all other on-road fuels. This actually brought it on par with one another. So there's no extra incentive for SAF compared to renewable diesel. So just to give you a quick look here, this is what was the $1.75 tax credit. So if you look at that second bar there, the darker green, that 45Z clean fuel production tax credit, already in all of these situations, even with the higher $1.75 tax credit, it's always more profitable for a facility to run renewable diesel than SAF. And you've actually now eliminated 75 cents from all of this too. So your chasm is actually growing wider between renewable diesel and SAF being able to be more profitable. So as you see here too, we've got some more of these facilities that are coming online. They can toggle back and forth between renewable diesel and SAF. The question now is, will they produce that extra SAF, or will they go back to producing more renewable diesel because the economics point that way? Or do they end up shipping it overseas, which we're also hearing some about, to meet the EU market? So couple last slides, and just to kind of give you an overview of the world SAF market, we are still just a drop in the bucket of what we're using for SAF. We're at just 0.3% of actual global SAF usage. We're seeing the difference in the EU approach, which I call the stick approach, versus the US carrot approach. But that carrot is obviously not even as enticing now because it went from $1.75 to $1. And so, we continue to have great hope for the SAF industry, but right now it's a lot of hype. And when we don't have that federal policy, states are going to have to step up and really lean into trying to encourage the overall industry to be able to stand on its own. And that takes some time, it takes some money. And right now SAF is really having some difficulties doing that. So just kind of a quick overview summary, ethanol exports continue to offer that easy trade win. But if export sales slow, that really has a huge risk aversion if we don't see those materialize. Soy oil is definitely the biggest winner in the RVO, but we're waiting to see what the decision is on SREs. And then, as I mentioned, SAF is really the biggest loser in the updated 45Z legislation. So with that, Rob, I'll turn it back over to you, and you can ask any other questions that we might have.
All right, reminder, if you have any questions, send them in. Jacqui, do you see any, I'll turn on my video too. Do you see any agronomic impacts from the change in 45Z such that we may have more cover crops or acreage shifting to whatever rapeseed or whatever? Any changes at the farm level?
So the 45Z, the fact that it does eliminate this indirect land use change does improve the overall CI score for like soy oil or corn oil. But unfortunately, some ethanol plants might be able to qualify for 45Z if they have the ability to pipe their own ethanol and store their carbon so they can get their score down. But the end of the day, they're maybe talking about a few cents premium, maybe max 10-cent premium, that they might be able to pass some of that onto the producer. So when you're talking about moving the needle and being able to really encourage significant production practice changes, there's just not enough money right now. There's not enough of that carrot to wave in front of a producer to get them to change. So with 45Z, I don't see that. There still might be some opportunities with food companies or others who are looking at regenerative ag or sustainability practices that offer a premium, but 45Z is not going to be the windfall that I think some had hoped it would be.
Yes, and that could have, for the past several years, I've been proposing an aggressive biofuels policy as sort of a workaround to our permanently low crop price environment. So that was one avenue policy could have chosen, but we didn't go that way. Again, for Jacqui, looks like you've got a few here. This one is maybe in the weeds. Not sure you know the answer to this. 45Z language, does it still eliminate the possibility of fuel such as ethanol going and getting the 45Z subsidy because the ethanol is already a fuel in itself and has gotten partially through. Let me just put it at that. Can ethanol go into SAF production and get that 45Z?
So I will say the alcohol to jet sustainable aviation fuel market right now is very, very small. So really the only facility that is using ethanol to produce SAF is LanzaJet, which is actually using Brazilian sugarcane ethanol to do it because of the CI. Now, the change in the indirect land use change may allow for corn ethanol to qualify for that, but the alcohol to jet process right now, GEVO is another one that is in the works of trying to establish its own alcohol to jet plant, and it's paying corn farmers to have a lower CI. So most of the SAF produced today is with the HEFA process, which uses the same process as renewable diesel. So is it eligible? Yeah, yes, but you're not getting, well, now the tax credit is the same. So it's the same for a low CI ethanol that it is for SAF, but you're not seeing much ethanol actually go into SAF because of the current market system and the fact that we just have pre-pilot projects. We just don't have big facilities that are processing alcohol to jet.
Okay. Related to SAF again, I think the gist of it is you showed the chart that showed that SAF was consistently less profitable than renewable diesel. What's the crux of that? Why is that? Is it just because it takes so much effort to turn the feedstock into SAF?
Yeah. And it's just the production process, what you have to clean, what you have to do. It's about 2 to 3 times as expensive, sometimes even as much as 6 times as expensive to produce SAF that is compared to renewable diesel. So we forget, and I was just talking with our great sustainability team at CoBank early this morning, we forget that the ethanol industry took decades to really become efficient and improve their efficiencies in a way that they no longer needed some of that federal support to assist them in being profitable. And we just have a lot more work to do to get the SAF process cheap enough to make it on par with your aviation fuel versus regular, sustainable aviation fuel. The renewable diesel, they've been able to figure out some of those economics, but again, it's a lot of it is driven by the fact that California has a low carbon fuel standard. So there's some money there that's going to that, which is a huge reason why we've seen such an influx of the use of renewable diesel, because it was helping meet that California demand, which had this tax incentive to fuel that growth in that market.
All right, another question on biofuels. Are you aware of any biofuel producers that are actually paying a premium for low carbon intensity grains?
So actually, I mentioned Gevo, and they do own now Red Trail ethanol facility up in North Dakota, I believe, or up in the Dakotas, and they are working on trying to pay a premium. There's a few that are that were part of the pilot projects that were funded through some of the Climate Smart Partnership funding, and then also Landis. They just set out this week. This is not necessarily. This is if they can track what you've done with your grain, there is an opportunity to capture a higher premium for some of their soy delivered to their Ralston facility. And there's a few things that they're doing. So some folks are trying to again, it's really pilots that are happening at these different areas to see what kind of incentives are needed, and if that's enough to move the needle. But this is not a wide scale process right now, for sure.
So the only other question we have here, well, actually, there was one that came in earlier I missed. Tanner, this EU deal that we have, I kind of looked at it. There's not a whole lot of details. Do you see any impact whatsoever on EU demand for US grain products?
Not directly. I think we're still lacking on details, Rob. Nothing clear on that yet. So in the meantime, it doesn't seem like anything. Only indirectly, I think there was some biofuel implications there, but nothing directly on grains.
Yeah, the big, you know, Liberation Day, I think the big story that the administration was trying to put out there was the non-tariff trade barriers, which of course many of the countries in the EU have with their non-GMO restrictions.
Right.
So that you would have thought may have been an obvious area of negotiation, but I didn't see anything related to that.
All they said was greater market access. At this point, without the details, I can mean anything. It could be phytosanitary things like you just mentioned there, Rob. I guess we're just gonna have to wait until we see the details.
Okay. Last question came in about kind of it used to be referred to as cellulosic ethanol or biofuels. This was, I think, part of the renewable fuel standards that came out in 2005. That's 20 years ago. There was a lot of optimism at the time of switchgrass in particular, but other kind of like cellulose-based mass that you could turn into ethanol, and that was going to be the wave of the future. But that's pretty much come to naught as far as I know, Jacqui. And that very small requirement in as part of the RFS, that gets waived every year, doesn't it?
Now, they really actually thought that we'd be able to have 15 billion gallons of ethanol and 30 billion gallons of cellulosic. So they really had anticipated all those years ago, 20 years ago, that we would have this huge surge. there was always a 5 to 7 year outlook that the cellulosic industry would be right around the corner in 5 to 7 years. And I was just mentioning to our sustainability team this morning, in some ways the SAF market is very similar. There's a lot of hope, there's a lot of hype, but we've got to figure some things out so that it doesn't fizzle out like we saw with the cellulosic. And so we've got to make sure that we're investing in it. We've got to make sure that we're creating a market, that there is the feedstock availability. We've got to have the research to bring the cost down. We've got to have the federal policy to help in those interim years as well. But yeah, we do waive the cellulosic requirements every year. So there is just a little bar of that that's still included, but we've not had that huge surge like we anticipated originally.
Okay, so that we're out of time and we're also out of questions, so that's perfect. I just want to remind folks we do put out a nice weekly grain-oriented newsletter called Gleanings. If you'd like to get a copy of that, send an email to Jacqui there. Her email's on the screen. And again, we're always happy. Questions, comments, send them our way, and we're happy to dialogue with you all. Again, thanks for joining us. Thanks for being CoBank customers and partners. We really appreciate it, and have a great day.